Hi, this is Adam Khoo here on the 10th of April, Good Friday, and I've got pretty tragic news. There's been a death with someone that we all know intimately really well, and the death is the bear. That's right, the bear market is officially dead, but the good news is the bull market is back. So let's take a look at the charts to really understand what's going on. Alright, so over here we have the S&P 500 index, and a bear market is defined as a drop of 20% or more from the high of the market. So the high of the market at the beginning of the year was 3393, and we dropped into a bear market over here. This is the 20% mark. So we went from the top of the market to a bear market, and it took 16 days. It was one of the fastest in history for a bull market to turn into a bear market. And it went, in fact, all the way down to a low of 2191. And that was a 36% decline from the high. As I mentioned before, if you look at all the bear markets in the last 100 years, the average decline of the 21 bear markets in the last 100 years was actually minus 36%. So it was pretty coincidental. Okay. Now a bull market is defined as a rise of 20% from the low of the market. So from this low of 2191, if you take 20%, it's 2630. This is the 20% increase from the low. So you can see that the market has just crossed that level, which means officially a bull market has begun. And the entire bear market lasted only 19 days. It was one of the fastest bear markets in the history of the world. In fact, I turned bullish on the markets way before that happened. In fact, I went bullish on the markets and started to buy stocks and take on bullish trades over here on the 3rd of April. Why? Because I saw a bullish engulfing pattern making a higher low from the previous low. So when I see higher lows and I see a bullish engulfing pattern, I turn bullish on the markets and I told my students I'm buying stocks right now. In fact, if you take a look at my private Telegram chat group with my students, this was back on the 3rd of April, as you can see over there. All right. And my message to my students was, yes, with a bullish engulfing pattern on the S&P, sentiment has turned bullish. I'm starting to buy stocks right now. Now, many people were surprised that the bear market ended so fast. They said, how could the bear market end? The economy is still in tatters, right? People are still dying. People are losing jobs. How can this be? I was not surprised, because if you are one of my students, you would have seen the signal that the market has actually hit a bear market bottom. The signal that the bear market was dead. And I'd like to share with you what are these signals that I look at. So for future bear markets, you can look at these signals yourself. So what are the early warning signs that the bear market comes to an end? So what are the early warning signs of a bear market ending? Well, there are 4 things I've looked at for the last 20 years, and they've proven very reliable, even for today's bear market. So what are the 4 things? The first thing is I noticed that bear markets tend to bottom when, number 1, we have extreme volatility as well as extreme oversold conditions. I'm going to show that to you in a short while, what that means, right? Number 2 is when we have got peak levels of unemployment. That's right, you heard me right. When unemployment hits a peak, usually it signals the end of the bear market. Next, when the market rallies in the face of bad news. And the 4th thing I look at is when the S&P 500 dividend yield exceeds the yield on the 30-year treasury bonds. These are the 4 leading indicators of a bear market bottom. So let's take a look at the first one right now. One of the most powerful signals that the bear market has bottomed is when I see extreme volatility. And this is measured using ATR, average true range. When you've got big ATRs, it signals a bear market bottom if it coincides with extreme oversold conditions. Now, I have actually taught this in my previous video, which you must watch, where I show you basically the last 50 years how accurate this signal has been. So I look at 2 indicators. If you remember from my previous video, do watch it. I look at what is known as the normalized ATR, or average true range. as well as the Williams percentage R that measures oversold conditions at the 52-week level. All right, so basically what am I looking at? When the ATR is above 80, right? This is the AT level, this dotted line. And if the Williams R is below minus 80 and they both happen at the same time, is the signal of a market bottom, and they must both happen at the same time, right? So you can see over here, this ATR crosses above 80 and the Williams R goes below minus 80, right? So when they both happen, that signals the bottom over there. That's how I could tell. Now, if you go back again 50 years, this signal has been very reliable. I've shown that in my previous video. Do watch that. You can see last year we had the 2018 bottom, same thing. Williams R below minus 80, coinciding with ATR above 80. So whenever you got the two signals together, boom, that's a bottom. That's a bottom, all right? And again, you can go back. So that was the first sign of the market bottom. Now, the second sign of a bear market bottom is when unemployment in the US hits peak levels. That's right, you heard me right. When you've got massive unemployment, people out of jobs, that's the time the market has bottomed, and that's the time to buy stocks. I know it sounds a bit counterintuitive. People always think, hey, I should buy stocks when things are going well, when people are fully employed. Wrong. The time to buy stocks is at the bottom, and that's when there's massive unemployment. Take a look at this chart over here and you'll see what I'm talking about. Now, over here you can see this blue line. This represents the stock market, the stock price. Okay, that's the blue line going up. This black line going up and down represents unemployment claims or jobless claim benefits. Okay, now check something out. Notice that when unemployment claims go up, that means more people are unemployed, right? Like over here you can see this is the 450,000 mark of people who are unemployed. Okay, and notice whenever the unemployment goes above this level, it signals a bottom in the stock market. The market bottoms, that's when you buy to catch the next bull market. Can you see that? Over here, same thing. When unemployment goes up above this mark over here, it signals the end of the stock market bottom and time to buy to catch the next bull market, right? Over here, the same thing. Notice over here, again, you can see unemployment going up to 450,000. That signals the bottom of the bull market, sorry, the bear market to buy to catch the next bull market, right? It sounds weird, but that's how it works. So where are we now in terms of the unemployment claims in the market? Well, check it out. Currently, right, the US jobless claims have hit 6.6 million. 6.6 million people are out of a job. Now that is terrible. That is really, really awful. I wish that it did not happen. But the point is, from the perspective of investing, that's when it's time to buy stocks. Because it tells us that when unemployment, like look at this, whenever unemployment really flies really high, right, it climbs really high, it marks the bottom of the bear market. Okay, now the next chart shows you the same thing. You can see over here, this red line represents the stock market, okay, and the blue line represents the unemployment rate. How many people are unemployed in the US? Now look at the 6% mark. Notice whenever the unemployment rate goes above 6%, what happens? Market bottom. Time to buy, right? Goes above 6%, market bottom, right? Goes above 6% again, market bottom. Goes above 6% again, market bottom. Above 6%, market bottom. So whenever unemployment rate goes above 6%, right, it's the bottom of the market, time to buy stocks to catch the bull market. Now, where is the unemployment rate right now? It is now at a whopping, my God, 14% unemployment rate in the US right now. 14% of people unemployed. So that is the highest spike in unemployment that again reverses to mark the bottom of the stock market, which I know is counterintuitive, but that's how the market works. All right, so far we have the first two signals, right? Extreme volatility, extreme oversold conditions. We've got peak levels of unemployment. And the third signal is the market bottoms when it starts rallying on bad news. That's right. See, bear markets die on bad news, not on good news. In other words, whenever you see a lot of bad news in the media, but the market no longer goes down, it starts going up, it tells you that the market is bottom because there are no more sellers left. Everyone who has needed to sell has already sold, and that's a sign of capitulation. So for example, take a look at this. This was back on the 5th of April, and this was the 5th and 6th of April. Look at the news in the media. US reports highest single day death since the outbreak. So that's terrible news, but what happens? The market goes up. US weekly jobless claims double to 6.6 million people. Bad news, market goes up. So when the market starts going up on bad news, it means it's over, right? Nothing else can make the market go down because the worst news has been priced into the markets. Fourth condition I'm looking at is when the S&P 500 dividend yield exceeds the yield of 30-year treasury bonds. You see, historically, when you buy government bonds, they are safer. So they should give you higher yields on interest rate yields higher than the stock market, which is the S&P 500. That should happen logically, right? But whenever the S&P 500, the stock market, gives you higher dividend yields compared to bond yields, that signals that the market has bottomed, because that means that stocks are cheaper than bonds. Stocks are undervalued and bonds are overvalued. So this triggers a flow of funds from big institutions from bonds to stocks, hence creating the next bull market. So if you take a look at this chart, you can see from 1977 to 2019, there's only been 2 times when the 30-year treasury yield, which is the red line, has gone below the S&P 500 dividend yield. It happened here at the bottom of the financial crisis that triggered the bull run after the financial crisis. And it also happened briefly during the Brexit, when Brexit was announced. And now it is happening again. Let's check it out. You can see right now that the US 30-year treasury rate is 1.35%. So if you buy 30-year government bonds, you're getting 1.35% return on your money. But the S&P 500 is offering a yield of 2.31%. So this exceeds this, signals that stocks are really cheap, they're at the bottom, and they're triggering the next bull market. Easy as pie. Now, whenever I tell people that the stock market's in a new bull market, a lot of people say, how can it be? The economy is in a recession, or going into a recession, or going to, in fact, a depression where there's going to be more job losses, more business losses. Things are going to get worse. You know what? I completely agree. The economy is going to get worse. We are going to go into a depression. I agree with that. But understand that the stock market is not the economy. That's the mistake people make. See, the stock market is a leading indicator of the economy. The stock market moves 6 to 9 months ahead of the economy. Because the stock market doesn't care what's happening now or what's happening next week or next month. The stock market cares what's happening in 6 to 9 months. So even though we're in a recession right now, but the stock market is already pricing in the recovery. Take a look at this really nice chart by Sam Stovall. And you can see, for example, this red line represents the stock market, all right? So that's the one in red. The one in green represents the economy. So you can see that when the stock market is at the bottom, right? The market's at the bottom, what's happening to the economy? That's right, the economy is in a recession. So the time to buy stocks at the bottom of the market is when we are in a recession, which is now we're in a recession, right? Now, the trouble is a lot of people think, hey, I'm going to buy stocks when the economy recovers, when the pandemic is over. Now, what happens once the economy fully recovers? When the economy recovers, what is happening? You are actually buying at the top of the market. And that's why most retail investors, when they see the economy doing well, they buy stocks. What happens? Stocks go down. But professional investors, we buy when the economy is in a recession, because when the economy is in a recession and we buy, we're buying at the bottom, so we catch the best price and ride the bull market all the way up. Now, if you take a look at the news headlines of the past week, what do you see, right? On the 26th of March, it says, jobless claims soar to 3 million, a record high. 30th of March, coronavirus job losses could total 47 million, pushing unemployment rate to 32%. 6th of April, Janet Yellen, the last Fed chairperson, she said second quarter GDP could decline by 30% with unemployment already at 12 to 13%. So these are all very bad economic news. What do you think the typical retail investor does when they read all these news? That's right, they will sell. They will sell their stocks, which is the most stupid thing you can ever do. What do professional investors do? Professional investors, when we see all these bad economic news, we buy, because it is a sign that the market has bottomed. I told you, you buy on bad news. Check this out. Look at this chart over here. Again, look at the numbers. 26th March, 30th March, and 6th of April. If you look at the S&P 500, you can see on the 26th of March, bad economic news, market goes up. 30th of March, bad economic news, market goes up. 6th of April, bad economic news, market goes up. Market goes up when economy is bad. Why? Because the stock market moves 6 to 9 months ahead of the economy. The stock market is not the economy. And that's why you can see that in my Telegram chat groups, whenever I buy stocks, I tell my students, right? For example, over here, 25th of March, I said I just added MasterCard at $236.40. And I added Estee Lauder at $158. And this was on the 25th of March over here. I started to buy stocks the moment I saw a change in the market trend. On the 26th of March, added Ping An Insurance at $75.60. This is a Hong Kong stock which I bought as well. On the 30th of March, added Facebook at $159. So you can see over here, I started buying more Facebook shares. On the 30th of March, I said adding Bank of America at $22.21, right? On the 30th of March again, I'm adding ASHR, that's a Chinese ETF, at $25.73. So you can see when people are reading all the bad news and they're selling, professional investors like me, I'm buying like crazy. And that is the difference between a retail investor and a professional investor. And sure enough, what happens after I buy? Then you read this news in the media. Hey, stock market live updates. Dow jumps 500 points, up 13% on the week. 9th of April, NASDAQ says bull market begins. Start of new bull market, right? So that's why the retail investor always gets screwed. Because they read the bad news, they sell stocks, and the moment they sell stocks, the media then tells you it's a bull market, and you're screwed. So never make decisions based on reading the mainstream news blindly. Always take a look at the price action of the market, at the intrinsic value of the stocks you buy, and learn how to use the indicators which I've been talking about in my videos. So by being able to add more shares at very undervalued prices near the bottom, I'm able to cushion the blow to my portfolio. So you can see this is one of the portfolios that I have. And yeah, my portfolio is still down for the year, right? In fact, my portfolio started at about $900,000 at the beginning of the year, and right now it's at $841,000. So it's still below the top of the year, right? Because as you can see that we have not fully recovered back to the high, okay? And that is why, like I said, because of that, my portfolio is still down from $900,000. Right now it's only $841,000. But when the market eventually recovers back to the high and beyond the high, then this account will be way more than $1 million, right? But despite that, you can see that most of the stocks that I have in my portfolio, they have unrealized profits. They are profitable. They are above what they're green, right? Because I added more shares at a very, very discounted price. That's the key to it. Now, let me just say also that important disclaimer. Just because we're at the beginning of a new bull market doesn't guarantee that we're going to go all the way to the top right away or beyond that right away, because no one can predict how long this bull market is going to last. Is it possible that the bear could come back for a rematch and get another bear market really fast? Sure, anything's possible. That's why as an investor, you always buy in stages. You always average into the markets. Never buy at one time. So I won't buy at one time. I buy shares consistently, so that even if the market goes down again and becomes more undervalued again, I'll just buy more shares, because I know in the long run, if I buy great companies at huge discounts, it will always go higher. And I'm certain in 6 months, in a year or 2 years, my wealth will multiply many, many fold, just like you and many of my students who are following the principles of smart investing. Now, I know that this pandemic and this shutdown, this lockdown has taken a toll on many, many people, financially, in terms of our health, in terms of our career, in terms of business. So I really appreciate you watching this video, and I do hope you're staying safe. And to show my appreciation and to contribute in a little way to your life, I'd like to send you some completely free reports on how do you manage your psychology, how do you train your mind to bring out the best in yourself. So what you can do is you can go to my website, which is adamkhoo.com, adam-khoo.com, go to my personal website and type in /stay strong. So that's adamkhoo.com/stay strong, and you can register for my weekly newsletter, completely free, when I send to you some of my most powerful tools and strategies on how to manage our mindset, our psychology, in order to bring out the best in ourselves. So that's my little gift to you, to show my appreciation for you watching my videos, and hopefully you can emerge from this crisis stronger than ever before. Thank you for watching, and I'll see you in the next video. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.